Hi friends, myself Subrata Mukherjee and you are watching my channel Dr. Subrata Mukherjee Distance Learning in Commerce. Today we are going to discuss another problem on dissolution. This is lecture number 3 in dissolution and lecture number 14 in partnership account. Today we are going to discuss about Gardner versus Murray rule. I would like to request my students to record the problem so that you can understand it properly, and the students can communicate with me through email which I have given in the description box. A, B and C were in partnership sharing profits and losses equally. The firm's balance sheet as on 31st December 2021 was as follows. On liability side, we have A's capital account 24,000, B's capital account 8,000, C's capital account 4,000, A's current account 10,800, creditors 64,000, plant and machinery 26,000, debtors 53,000, stock 22,200, cash 1,600, B's current account 2,000, C's current account 6,000. Total of balance sheet is 1,10,800. It was decided to dissolve the firm on 31st December 2021. The plant and machinery, debtors and stock were sold by the firm for rupees 70,000 and the creditors were paid off. C was declared insolvent and could not meet his liability towards the firm. From the above, prepare the realization account, partner's capital account and cash account. Apply the Gardner versus Murray rule. So here we have prepared the structure of the different ledgers we are going to prepare. So first is the realization account, then the cash account, then partner's capital account and partner's current account. First, we are going to transfer the figures which are given in the balance sheet. So the first figure is the plant and machinery which is appearing in the asset side. So realization account debit to plant and machinery account. $26,000. Next is debtors. So realization account debit to debtors. 53,000. Next is stock. So realization account debit to stock. 22,200. Next is the balance of cash. So I have to record it in the cash ledger to balance BD 1,600. Then we have B's current account. So in partner's current account, I have to record to balance BD 2,000 and 6,000. Now come to the liability side. So first item is the capital of A, B and C. So in partner's capital account, I am recording by balance BD 24,000, 8,000 and 4,000. Next is A's current account. So in the current account, partner's current account, I have to record by balance BD 10,800. Next, we have creditors 64,000. So this balance we have to record it in the realization account. So creditors account debit to realization account. So by creditors account 64,000. So we have recorded the figures which are there in the balance sheet. Now the assets are sold and 70,000 has been realized. So cash account debit to realization account. So by cash, I have to write here as 70,000. And in cash account, to realization account 70,000. Creditors have been paid. So realization account debit to cash account 64,000. So this is the amount that has been paid to creditors, and in cash account I am recording here by realization account 64,000. Now we are going to close the realization account. So we have a loss in realization, and the amount of loss will be transferred to partner's capital account. So total of the debit side is 1,65,200, and loss on realization is 31,200. So by partner's capital account A, B and C. So 31,200 will be shared among A, B and C equally, because the PL ratio, that is the profit sharing ratio among the partners, is equal, that is 1:1:1. So 10,400 will be shared by A, 10,400 will be shared by B, and 10,400 will be shared by C. So here we have closed the realization account. So you can see that on the debit side of realization, we have transferred the assets, that is realization account debit to plant and machinery, to debtors to stock, and creditors has been credited to realization account for rupees 64,000. 70,000 was realized from the sale of the assets, and 64,000 was paid to creditor. And amount of loss on realization is 31,200, that has been shared among the partners as 10,400 each. Now this loss will be transferred to partners capital account. Partners capital account debit to realization account. 10,400 . Now we are going to close the partner's current account by transferring the balance to partner's capital account. So to partner's capital account, here 10,800, and on the credit side I am recording by partners capital account 2,000 and 6,000. So this amount will be transferred to partner's capital account. Now C is insolvent. Partner C has been declared insolvent, and we have to apply here the Garner versus Murray rule. So in Garner versus Murray rule states that the solvent partners, they have to make good the loss on realization. So the partners A and B, they have to bring in cash to the extent of loss on realization they have shared. So partner A and B have shared the loss of 10,400 each. So partner A and B is going to bring in cash. So by cash account 10,400 A and B will bring, and the deficiency of the insolvent partners will be shared between the solvent partners in their capital ratio. So two point you have to remember in the Garner versus Murray. Number one, the solvent partners have to bring in cash, and they have to make good the loss on realization. So A and B are solvent partners, so they have to bring in cash to the extent of loss they have shared in realization. So partner A has shared 10,400 and B has shared 10,400. So cash account debit to partner's capital account 10,400 I have recorded in the column of A and in the column of B. So in cash account we have to record to partner's capital account. A and B. The second point in the Garner versus Murray rule states that the deficiency of insolvent partner will be shared between the solvent partners in their capital ratio. So the deficiency of partner C is 12,400. So this is the deficiency, 12,400, that will be shared between the solvent partner A and B in their capital ratio. So their capital is 24,000 and 8,000. So here I am writing by A's capital account 9,300 and by B's capital account 3,100. So you can easily calculate 12,400 into 3 by 4, that is 9,300, and 12,400 into 1 by 4 is 3,100. So this is basically a contra entry. So on the debit side, you can record to C's capital account 9,300 and 3,100. Now you have to pay off the amount which is due to the solvent partner. So total of A's column is 45,200 and the balancing figure is 25,500. This is 18,400, the total of B's column, and 2,900 will be paid to B. Now this amount I have to transfer in cash account. So by partners capital account A and B, 25,500 and 2,900. So 28,400. So you can see the entire solution in one screen. So we have prepared 4 ledger: the realization account, cash account, partners capital account, and partners current account. First of all, we have transferred the assets which are appearing in the balance sheet to realization account, and the liability also to realization account, that is here only the balance of creditor. So realization account debit to plant and machinery 26,000, realization account debit to debtors 53,000, realization account debit to stock 22,200, creditors account debit to realization 64,000. The balance of capital and the partners current account we have recorded in partners capital account and partners current account, and the balance of cash 1,600 has been recorded in the cash ledger. Now assets has been sold out and 70,000 has been realized and 64,000 has been paid off to the creditors. So the loss or realizations 31,200 has been shared by partner ABC equally, and 10,400 each is the loss of realization. Now you have to discuss about the Garner versus Murray rule. So it states that the solvent partner has to make good the loss on realization. So here the partners A and B are the solvent partners. They have to bring in cash the amount of loss they have shared, that is 10,400 each, and the deficiency of the insolvent partner will be shared between the solvent partners in their capital ratio. So the deficiency of C is 12,400 that has been shared by A and B in their capital ratio, that is 24,000 and 8,000, that is 3:1. Now after the deficiency of the insolvent partners has been borne by the solvent partners, we have calculated the amount that was due to the solvent partners, and that is 25,500 and 2,900 has been paid off to the partner A and B. Thank you. Thanks for watching the lecture.